This is Macro Horizons, episode 383, Guarding the Goal, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 20th. In the wake of Warsh's renewed commitment to the Fed's goal of 2% inflation over time, we're reminded of the sage wisdom, if at first you don't succeed, then skydiving is not for you. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the biggest takeaway was that core inflation was 0.0% in the month of June. Headline CPI dropped 0.4%, obviously owing to a pullback in energy prices. Even headline PPI was negative at negative 0.3% in June, with core PPI coming in below expectations at 0.2%. Taken in aggregate, the week's data has effectively removed the probability of a July rate hike, which, frankly, is consistent with our expectations, and we suspect that as the course of the summer unfolds, the balance of the data will also lead investors to revise later any estimates of potential rate hikes. We're not going to make the argument that a September rate hike should be off the table per se, and as the market currently has it priced in as roughly a 50-50 chance, we suspect that the incoming economic data between now and mid-September will diminish the market's rate hiking ambitions, at least at the September meeting. Keep in mind that between now and the September meeting, we will have two CPI prints for the month of July and for the month of August. To say nothing of the updates on the employment front. Warsh's first semi-annual congressional testimony as Fed chair demonstrated his ability to limit the amount of forward guidance, even to Congress, which on net was taken as a positive by the market. Not so much that he is reluctant to give forward guidance, but rather that he has continued to demonstrate an aptitude at navigating congressional testimony, if nothing else. Geopolitics were once again front and center as the conflict in the Middle East continues to escalate. The most notable aspect of the increased tensions between Iran and the U.S. is the lack of follow-through in the energy sector. Yes, oil prices are higher, but not dramatically so. The front-month WTI moved above $80 per barrel at one point, but appears to be stabilizing in the high 70s. This implies that any forward inflationary concerns should be limited or at least offset by the fact that energy prices have not surged back to the levels that we saw earlier in the conflict. Now, it goes without saying that the situation in the Middle East remains a wild card, and further escalations could change the market's perception of what it means for the energy complex. But as it appears, for the time being, the market seems content with the notion that eventually there will be some resolution, the Strait of Hormuz will reopen quickly, and there's currently enough supply in the system to meet the constrained demand that has resulted from the conflict. As a theme, we've been on board with the rally in the Treasury market and expect that the path of least resistance over the course of the coming weeks will be towards lower, not higher yields. In large part, that's a function of the fact that some of the acute inflationary risks have yet to translate through into core prices. This isn't to suggest that such an eventuality might not occur, but the magnitude of the downside in the June CPI and PPI numbers indicates that the market has time, if nothing else, to gain a better understanding on the degree to which, if at all, headline inflation is bleeding through to the core series. And with that information, investors will then be able to further refine monetary policy expectations for the balance of this year.
We're now well into July. We have CPI, we have payrolls, and we're preparing for the July FOMC meeting. And while there's been no shortage of sources of volatility so far this year, we've had a war in the Middle East, we've had oil at $120 a barrel, equity prices at record highs, credit spreads at record tights, all with the backdrop of a Fed under new management with an eye on reforming how monetary policy is conducted, many of the longer-running core economic tenets that were brought into 2026 remain intact. The question from a monetary policy perspective is how the labor market is responding to rates at these levels, what the potential regulatory changes in terms of the administration's agenda for the financial sector will mean about demand for treasuries, and also the treasury supply backdrop, which will become increasingly relevant as the August refunding process approaches. One thing that hasn't played out this year, which many were concerned about coming into 2026, was a broad-based de-dollarization of the global financial system. The dollar has been nothing if not strong so far this year, and a general shift away from dollar-denominated assets, as a function of political pressure and as a function of deficit concerns. Instead of 10-year yields careening towards 6%, as a function of a buyer's strike in treasuries, what we've seen is a recalibration of the global investor community's relationship with U.S. rates, but that recalibration has hardly been a complete step back as the administration remains focused on the deficit, the growth outlook has remained resilient, and the rate outlook has shifted materially from where it was coming into this year.
And it strikes us that we did spend a lot of last year, i.e. 2025, worried about some of the key bond bearish risks that have always been part of the broader market discussion, but were frankly exacerbated by Trump's tariff agenda. Recall that there was a moment in which the market truly believed that the dollar would lose its status as a reserve currency, and as you point out, Ben, that certainly didn't happen. We also had a moment in which there was true concern that overseas holders of treasuries would sell en masse all of their treasury holdings, thereby effectively dumping bonds back into the market and triggering a bearish repricing. Clearly that didn't happen. There was also concerns that investors would boycott the auctions. In fact, what we saw was solid auction demand throughout most of 2025. Adding to the list of bond vigilante concerns that didn't come to fruition was the deficit. The market was having conversations about the deficit ballooning to 7 or 8% of GDP. In fact, due in no small part to an increase in tariff revenues, we saw the deficit shrink throughout much of last year and into 2026. Currently, the deficit as a percentage of nominal GDP is just 5.2%, a far cry from the 7.5% concerns that have been out there. Now, to some extent, this is a function of the fact that the administration took a wager that they could, for all intents and purposes, grow their way out of a larger deficit. And yes, to some extent that has occurred because GDP has outperformed expectations over the course of the last 5 quarters. But what has also occurred is we have seen inflation remain stickier on the upside than was expected. And so, as a result, nominal GDP has continued to grow, which means that the nominal deficit is consequently smaller. Now, whether or not this dynamic holds for the balance of 2026 and into 2027 remains to be seen. Recall the other major bond bearish risk that the market managed to sidestep last year was the 100% pass-through of tariff inflation to realized prices. To be fair, we did see core goods prices increase during several months of 2025, but to a large extent, that ended up being a temporary influence and nothing more than a one-time price adjustment, which was always the Fed's assumption. The fact that we're still having the conversation about inflation is more a result of the war in Iran and the subsequent energy shock. So when we look back at how far we have come away from the key bond bearish risks that defined much of 2025, it's encouraging to see that we are, once again, back to trading the fundamentals of inflation and growth expectations combined with a bit of term premium and monetary policy expectations over the course of time. All else being equal, at the beginning of the year, we would have expected nominal rates to be lower than current levels as the proverbial dog days of summer are quickly approaching. However, there is solace to be taken from the fact that we are in a familiar range for nominal rates.
And that's not solely the case in the US, but also overseas. And while gilts, JGBs, and ECBs have demonstrated their fair share of volatility so far this year, along with the moderation of the price of oil, has also come a moderation in the upside inflationary risks that are facing Europe. Remember, in the early days of the conflict in the Middle East, the big concern was that given the nature of Europe's relationship with the oil market and the fact that the European economy is much more sensitive to higher prices, that we were going to need to see an aggressive series of rate hikes from both the Bank of England and the ECB. Now, we saw rate hikes, but as we've heard from Bailey and Lagarde a few weeks ago, the more extreme tail risk of a paradigm shift toward higher overnight rates in Europe have moderated. And similar to the tariff discussion, where there was concerns that Trump's tariffs were going to drive a global recession and a massive increase in broad-based inflation as trade wars between the US and all of its trading partners escalated, instead what we've ultimately seen is, again, a moderation of the tail risks that would have otherwise caused a far more volatile global economic outlook. And so, in translating what that ultimately means for treasuries, it's not especially surprising that, broadly speaking, we've seen treasury yields hold a range. Now, it's not a particularly narrow range, but nonetheless, 2026 so far has not really been a trending market. 450/10s was relevant for a large part of the first and second quarter, and while two-year yields have repriced to a higher plateau than many were initially expecting coming into this year, given the rethink of the path of Fed funds, even the front end has been relatively well behaved after the repricing that was catalyzed by the move in oil, but then ultimately was given staying power by the evolution of the labor market and the strength of hiring that we've seen over the past several quarters that have obviously not only pushed out rate cut expectations, but introduced rate hike pricing in the later part of this year as well. And still, even though Powell is no longer chair, we have a firmly data-dependent mantra from the Fed and a preference to wait and see. All of that has meant policy rates in a relatively steady place, with some hike premium priced in, which frankly has left the quote-unquote big trade in the US rates market this year basically fading the extremes.
And fading the extremes is certainly a strategy that has proven relatively successful, even as some of the broader trends have failed to materialize in terms of curve shape, in terms of outright yield levels. Stability is not a bad thing, as we can see by the performance of risk assets over the course of much of this year. Also, in keeping with the theme of how far things have come since the beginning of 2025, recall that there was a moment in which the administration was attempting to remove Powell as Fed chair or pressure him into resigning or even announcing an early replacement for Powell. What ultimately transpired was, we'll argue, the best possible outcome for the Fed as an institution. We have a new Fed chair that is generally seen as being willing to do what it takes to maintain the price stability assumption while also being cognizant of the employment mandate. We had a transition of power, as it were, on the FOMC that was, frankly, seamless and without incident. So when we put this all in the context of the credibility and the reputation of the Fed as an institution, it has been a pretty good start to Warsh's term.
And this is very much in keeping with the theme of 2026 was expected to be a year of extreme volatility and massive change, given all of the factors that we've discussed. But ultimately, the Fed as an institution and the dollar's credibility as the reserve currency continues to be reinforced. Warsh's commitment to maintain price stability, albeit with a much shorter FOMC statement, certainly runs counter to the dynamic that you touched on, Ian, which was that any nominee of President Trump was going to come in and immediately cut rates. Instead, what we've seen is what we'll argue is probably an overdue review of how the Fed handles economic data and how it delivers communication to the market. This has come along with a deficit situation that certainly needs addressing, but is at the top of the priority list for Secretary Bessent, and we're going to be eager to see how the evolution of Treasury issuance, whether that takes the form of more bills and less bonds, or ultimately what comes to pass in terms of alternative revenue sources for the Treasury. With nearly 7 months of trading in the books so far this year, it seems as if the most appropriate way to categorize the Treasury market in 2026 has been, it won't be quite that dramatic.
Or will it? The week ahead has a remarkably small amount of fundamental inputs on offer. The economic data calendar is all but empty. We do have the ADP weekly series as well as jobless claims on Thursday and new home sales on Friday morning. It's the Fed's period of radio silence ahead of the upcoming meeting, so there won't be any Fed officials offering a fresh take on the downside seen in realized inflation during June. So in this context, the Treasury market is likely to be relatively well contained within the range, with the one major wild card being, yet again, developments in the Middle East and any implications for the energy sector. Looking a bit further out, we continue to expect that the Fed will not hike rates on the 29th of July and offer a sparse FOMC statement yet again. Warsh will hold a press conference, and of course, investors will be watching for any clues or indications that the Fed is more seriously considering a rate hike at the September meeting. On net, however, given the benign inflation seen in the month of June, if nothing else, the FOMC has bought another couple months' worth of economic data to remain on hold and get a better understanding and assessment of how the real economy is performing in the current environment. While the Treasury market has pulled back from the local yield peaks, rates clearly remain sticky to the upside. Part of the story is a real yield story. Real yields are elevated, and that has led to some interesting conversations about whether or not this is the new norm, or if we're simply seeing a sector rotation given the significant amount of corporate issuance that has recently hit the market. Our take is that it is a combination of factors. First, there is a significant amount of issuance coming from the corporate sector, particularly related to the AI build-out. But there's also an argument to be made that given the shift in monetary policy expectations since the beginning of the war, i.e. from pricing in rate cuts to pricing in rate hikes, that real rates should be drifting higher because perhaps we have reached terminal for the cycle. Again, this isn't our base case, but we're certainly open to the logic that has seen 10 and 30-year real rates drift higher over the course of the last several weeks. Looking forward, it is worth highlighting that break-evens overall have been remarkably well contained, whether that's 5-year forwards, or 10-year break-evens in outright terms. The takeaway from market-based measures of inflation expectations has been one of confidence in the Fed's willingness and ability to fight inflation effectively over time. Warsh's commitment to the 2% inflation target has certainly reinforced our understanding of Warsh as a champion of Fed credibility and independence, which we expect will be the case going forward. And as the Warsh Fed secures Fed credibility, we anticipate that longer-term break-evens will be compressed further, providing an offset to the fact that real rates have drifted higher. Taking all these factors together, we continue to anticipate that 10 and 30-year yields will trade in a range over the course of the next 2 months, and we'll argue that we just went through the process of defining the upper bound of the range, and the summer months are poised to be characterized by a shift from a bearish underpinning to a shift in favor of a bullish underpinning. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As a friendly reminder, the XSTEL Global Fixed Income Research Poll is now open. We would truly appreciate your support with 5 stars in our key categories of U.S. rates, technicals, fixed income, and short duration. The poll will run until Friday, July 24th, so there is still time. Thank you for your help. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.